Taxes cause great confusion and concern for almost everyone. But a little knowledge and preparation can make taxes just as easy as anything else. Welcome to part 16 of my Mind Your Money series, Tax Planning. Today we delve into the critical role of tax planning when it comes to personal finance. Tax planning is all about minimizing what you owe in taxes, while staying within the legal framework. It's a fine balance, but with knowledge and strategy, it's achievable. First up, let's dive into the essentials. Grasping the concept of tax brackets is a crucial starting point. Your tax bracket, put simply, is the rate at which your income is taxed. However, it's not as simple as it seems. Let's break it down with some examples. Suppose you're a single filer. If your taxable income for 2021 is up to $9,950, you're in the 10% tax bracket. If it falls between $9,951 and $40,525, you'd be in the 12% tax bracket. And the rate continues to escalate as your income increases. $40,526 to $86,375 lands you in the 22% bracket, while $86,376 to $164,925 puts you in the 24% bracket. The highest tax bracket, 37%, applies to those making over $523,600. So the more you earn, the higher your tax rate. But remember, it's a progressive system. This means that you pay the rate only on the part of your income that falls within that bracket, not your whole income. So even if you're in the highest tax bracket, you won't pay that highest rate on all your income, only on income above $523,600. This progressive system ensures a fair distribution of the tax burden among different income earners. Now let's dig into tax deductions. These are specific expenses that you can legally deduct from your taxable income. By lowering your taxable income, deductions have the potential to drop you into a lower tax bracket, resulting in a lesser amount of tax you owe. There are various types of tax deductions you can take advantage of. For instance, mortgage interest is a common tax deduction that homeowners can claim. This means if you're paying interest on your mortgage, you can subtract that amount from your taxable income. Charitable contributions are another form of deduction. If you donate to eligible charitable organizations, the amount you donate can be deducted from your taxable income. Then there's student loan interest. If you're paying off a student loan, the interest you're paying can also be deducted from your taxable income. Medical expenses can also be deducted from your taxable income if they exceed a certain percentage of your income. There are more, but these are some common examples. In a nutshell, every deduction you can take reduces your taxable income. The key is to understand the types of deductions you are eligible for and claim them accurately. This way you can potentially reduce the tax you owe and keep more of your hard-earned money. Moving on to tax credits, which serves as an indispensable financial tool in reducing your tax liability. Essentially, tax credits can be viewed as a dollar-for-dollar reduction of the taxes you owe. Unlike tax deductions that reduce the income subjected to taxation, tax credits directly cut down the amount of tax you owe. Several notable tax credits are available. The Earned Income Tax Credit, EITC for instance, caters to low to moderate income working individuals and couples, especially those with children. The Child Tax Credit, on the other hand, provides a credit up to a certain amount per child under the age of 17. Other examples include the American Opportunity Tax Credit and the Lifetime Learning Credit that help offset higher education costs, and the Residential Energy Efficient Property Credit, aimed at promoting energy efficiency. These tax credits, and others, can considerably reduce your taxes, potentially resulting in a refund. Let's shuffle on over to the world of tax-efficient investments. One prime example of a tax-advantaged account is the 401k. Named after its section in the tax code, a 401k lets employees save and invest a portion of their paycheck before taxes are taken out. Taxes aren't paid until the money is withdrawn from the account. Then we have individual retirement arrangement, or IRAs. These can be either traditional or Roth. With a traditional IRA, contributions are tax deductible in the year they are made, but withdrawals during retirement are taxed. On the other hand, a Roth IRA allows contributions to grow tax-free, and withdrawals during retirement are also tax-free. You can also have a Roth version of a 401k. Next up, health savings accounts, or HSAs, which are another type of tax-advantaged account. These allow individuals with high-deductible health plans to pay for certain medical expenses with pre-tax dollars, thereby lowering their overall taxable income. In addition to these accounts, holding onto investments for a longer period can also provide tax benefits. For example, if you hold onto a stock for more than a year before selling, you'll pay a lower tax rate on your profits, which are termed as long-term capital gains. Even some types of funds are designed with taxes in mind. Tax-managed funds, such as mutual funds and ETFs, are managed in a way to minimize taxable distributions. And so, they can be a good option for those looking to further decrease their tax burden. These different tax-efficient investments each have their unique methods for reducing taxable income, leading to potential long-term savings. Let's dive deeper into strategies for effective tax planning. The first strategy is tax loss harvesting. This involves selling investments that are at a loss. The idea here is to offset capital gains with those losses, thereby minimizing your overall taxable income. It's a tactical move that can reduce your tax liability substantially, and this shouldn't be attempted by individuals, but discussed with a professional who can help navigate these decisions. Another important strategy is contributing to retirement accounts for tax benefits. One example of this is the traditional version of the 401k or IRA we mentioned earlier, where the money you put in isn't just tax deferred, your contributions are often tax deductible as well, meaning it reduces the amount of income tax you owe. Additionally, the gains from these investments are not taxed until you start making withdrawals during retirement. Lastly, there's the utilization of health savings accounts, HSAs, for their triple tax advantages. These accounts are tax-exempt, meaning contributions are deductible, growth is tax-free, and withdrawals for eligible medical expenses are also tax-free. This makes HSAs an extremely efficient tool for reducing your tax burden while saving for healthcare expenses. One crucial factor that should never be overlooked is the importance of staying up to date with tax changes. Tax codes can alter every year, and these adjustments can significantly influence your tax planning strategies. These changes could include alterations in tax rates, introduction of new tax laws, or even deletion of old ones. Staying uninformed about these modifications can lead to miscalculations in your tax planning, potentially leading to penalties or missed opportunities for deductions. Another important thing to remember with all of these useful tax hacks is that the value of a tax professional cannot be overstated. They don't just offer vital, personalized tax planning advice, but they meticulously prepare your tax return to ensure accuracy. They can even offer assurances and protection against audits and deal with the IRS on your behalf. Believe me, that alone is well worth the money. A tax professional stays up to date with the ever-changing tax landscape and can guide you through these complexities, offering clarity and confidence. They can also assist with tax planning year-round, helping you optimize your financial strategies and minimize tax liabilities. This proactive approach to tax planning can lead to significant savings, making the cost of hiring a professional worthwhile. So, whether you're a business owner or an individual, staying informed about tax changes and consulting with a tax professional can prove to be highly beneficial. So, to briefly recap, because there was a lot here, empower yourselves in the realm of taxes. Diving deeper and gaining a basic understanding of tax planning concepts is priceless. It gives you the knowledge to navigate the complex world of taxation, and helps you identify potential tax savings. Exploring tax-efficient investment options is not just about multiplying your income, but it's also about preserving your wealth by reducing the amount of taxes you pay. These could range from retirement plans to health savings accounts, and even to certain types of real estate. Lastly, consider hiring a tax professional. Because a tax professional has the experience, expertise, and up-to-date knowledge of tax laws and regulations to guide you through tax planning and preparation. They can help you avoid costly mistakes, find hidden tax deductions, and strategically plan to reduce your tax obligations. In essence, combining these three elements is one of the most cost-effective ways to optimize your tax efficiency. Remember to subscribe to this channel and give this video a thumbs up to stay informed about future episodes of Mind Your Money. I'll see you in the next video.